Up until recently, if you were a rich Chinese guy and somehow you could get your money into Hong Kong, you bought U.S. Treasuries, you were earning, let's say, 4% yield. And on top of that, if the renminbi was going down 3-4% a year against the US dollar, now you're making 8% a year in renminbi terms at a time when there's no inflation in China. So that's 8% real. That's a fantastic trade. And it's a very low volatility, very easy. I think this week is upending all this, because people who were playing that carry trade in Taiwan, people who were playing that carry trade in Korea, all of a sudden, they've lost 2 years worth of gains in 72 hours. All the carry trade players got carried out. I'm going to be a bit vulgar, but it's the old story of carry trades. You eat like a bird and you poop like a cow. And that's what's just happened to the Taiwanese pension funds, to the Korean insurance companies. And so now if you're a rich guy in China and you just saw the Taiwanese dollar go up 10% or so in over 2 trading sessions, do you still feel as comfortable being massively long U.S. Treasuries, being just long Hong Kong dollar bank deposits? Maybe you don't. And if at the same time, I think this is very good timing by the PBOC, because if at the same time you've got a PBOC that comes out and says, look, we want to crank up asset prices, we're going to cut interest rates, we're going to do QE, and we're going to crank up asset prices, all of a sudden, if I'm that rich Chinese guy sitting on the Hong Kong dollar bank deposits in Hong Kong, I'm thinking, you know what, maybe I should be buying some shares here. And I think that's why you're seeing the market reaction you're seeing. The CNH isn't really going down, but stocks are definitely going up.